Hello everyone. Welcome to today's session. The retail profit illusion. Profit on paper, cash nowhere. Let's fix it. At Consulting and Beyond, we take pride in being one of the leading audit and consulting firm dedicated to helping business navigate financial complexities with clarity and confidence. With more than 25 years of experience across diverse industries, we have consistently delivered strategic solutions. Our expertise spans across four core verticals: audit and assurance, management consulting, corporate finance, and tax advisory, positioning us as a comprehensive partner for business excellence. Our success is driven by a strong leadership led by Mr.
देख
Umesh
मेरा कैम
Golecha, the
मैं
founder,
देखूं कहीं
and
देख के
supported by Ms. Ratandeep,
तो
the
बीमार स्क्रीन
co-founder,
ही जा
and guided
अपन
by the
स्क्रीन
wisdom of our
या
mentor, Ramakrishnan. Today's webinar will be presented by CA Kumar, one of our team leaders, together with myself, Sudharshan, and Padmesh, senior analyst. In this webinar, we will combine insights from all our business verticals to address one of the most pressing challenges in retail: the illusion of profits that fail to convert into real cash flow. Through case studies, practical frameworks, and actionable strategies, we will explore why this disconnect happens and how retailers can successfully overcome it. By the conclusion of today's webinar, you will not only understand the root causes of this issue, but also gain practical solutions to protect your cash flows, strengthen financial health, and ensure sustainable growth in retail. We'll start with a very common myth in retail business that if my book shows profit, then I must be financially strong. On the surface, this seems logical, but in reality, when you open your cash box or check your bank balance, the numbers often don't match what is shown on paper. You may have lakhs or even crores in profit as per your profit and loss account, but very little to actual money in your hand to pay your creditors or rather invest in growth. This mismatch is what we call the retail profit illusion. In today's session, we will decode why this happens and, more importantly, how you can overcome it. Our goal is to help you see beyond profit on paper and focus on true cash health in your business. Let me illustrate this with a real life example. One of our clients did 52 crores of sales last year. The books proudly showed a profit of 2.5 crores. But when creditors came asking for payments, the actual cash and bank balance available was just rupees 25 lakhs. Can you imagine the shock the owner felt? This is the harsh truth that many retailers face. Profit does not automatically translate into liquidity. You might be profitable on paper, but unable to pay your suppliers, your employees, or even meet basic operating expenses. The key lesson here is that profit is not the same as cash flow, and ignoring this difference can put your business at very serious risk. So, what are we going to cover today? I have broken this session into six parts to give you a complete picture. First, we'll understand the retail profit illusion in detail. Then, we'll explore the inventory black hole, which shows how stock silently eats your cash. Next, we'll examine the margin leakages and pricing gaps, which silently reduces your profitability. We'll also look at the overhead creep, where costs rise gradually and eat your margins. Another important area is profit diversion by owners, a common but often damaging practice. Finally, we look at the key metrics tab to keep on that will give you a practical tool to build financial discipline in your business. Now, let's look at some of the most common problems we see in retail businesses. First, many believe that cash sales mean cash availability. But even if 95 to 98% of the sales are in cash, creditors are still not being paid on time because that cash is flowing out elsewhere. Second, owners often withdraw profits for personal use, leaving very little money within the business to sustain operations. Third, there are hidden outflows after profit like income tax, EMI repayments, chit fund contributions, and fixed asset purchases, all of which drain your liquidity. Fourth, cash often gets locked in stock that takes 6 to 12 months to move, leading to shortages. And finally, blind discounts and clearance sales reduces your margin, giving a false sense of sales growth but no real profitability. I'm sure many of you can relate to at least one of these issues in your own businesses. Now, let's talk about the three big illusions every retailer needs to be aware of. The first is that profit does not equal cash. Profit is a book entry, but cash is real. If your profit is stuck in unsold stock, or withdrawn for personal use, it never turns into liquidity. The second illusion is that cash sales do not guarantee cash availability. Even if 98% of your sales are in cash, decisions like chit investments, land purchases, or EMI payments can quickly drain your money. The third illusion is that creditors don't care about your profits. Your suppliers and lenders judge you not by your P&L but by whether you pay them on time. Delayed payments damages your credibility and your future credit terms. In short, profits may keep you happy, but timely payments keep your suppliers happy. Now, let's pause for a quick interactive moment. Think about your own business. Which factor causes the biggest cash crunch even when your profits look good? Take a moment to reflect on this because identifying the source of the cash crunch is the first step towards fixing it. And if you are not sure, that's also a sign that cash tracking may not be as strong as it should be. Now, I request the audience to submit their responses. Okay, now that I've seen it, the majority of responses indicate preference to option A. However, it is important to note that all the options equally contribute to cash crunch even when profits appear strong. So, what should you, as business owners, do differently? The first step is to change the way you track your performance. Instead of only focusing on net profits, start tracking cash flows and stock turnover before profit. Cash flow is king, stock turnover is your queen, and net profits comes only after that. The second step is to have a clear profit allocation plan. Plan effectively to ensure that obligations like taxes, EMIs, operational expenses, supplier payments, and reinvestments are met in a structured manner, helping you manage cash flows more efficiently than making random decisions. Systematic growth capital accumulation helps in seamless growth without hampering the business cycles. Finally, treat your creditors as business partners. Paying them on time strengthens your relationships, ensures a smooth supply chain, and may even improve your credit terms in future. This discipline, more than anything else, will keep your business strong. So, here's the key takeaway from this section. Cash sales don't guarantee you cash health. Profit doesn't guarantee that you will be able to pay your creditors. What really ensures strength is disciplined allocation and reinvestment. In retail industry, discipline is more valuable than chasing top-line sales. A business that consistently pays its creditors, manages its inventory well, and allocates profits wisely will always be stronger than just showing big profits on paper. Keep this in mind as we move forward. Now, let's shift to the biggest cash killer in retail, which is inventory. Most retailers believe that as long as their shelves are full, their business is safe. But the reality is very different. Excess inventory silently eats your cash, reduces your ability to pay your creditors, and blocks your business growth. You may feel secure because the shops look stocked, but in reality, your working capital is sitting idle in the form of unsold goods. This is what we call the inventory black hole, and it's one of the top reasons why even cash rich businesses end up with cash crunch. The illusion with inventory is that stock equals security, but the truth is stock equals blocked cash. Imagine having shelves full of saris, shirts, or chudidars. Yes, they are assets in accounting terms, but in reality, they are not liquid. You can't pay your creditors with unsold fabric. You can't pay your EMIs with unsold stock. And until the stock moves, that cash remains stuck. This trap is the reason so many retailers feel they are doing well during peak seasons but struggle to pay creditors after one season ends. The inventory must be controlled and managed with the same discipline as cash. The first inventory issue comes from buying too much compared to actual sales. Why does this happen? Often it's because of emotional buying decisions. Owners buy based on instinct, not data. Sometimes it's the temptation of the supplier credit or the excitement of the festive season. And many times there's no proper stock analysis. So new arrivals keep coming in while the old stock remains unsold. The solutions to these problems are pretty clear. Implement purchase discipline by buying only what your sales history justifies. And additionally, factor in recent customer buying trends and general customer behavior across the industry to make more informed stocking decisions. Apply the VROQ technique, which stands for variety, relevance, optimal, and quality of the stock. What is sold should be purchased. And run regular aging and STR analysis to monitor how fast your stock is moving. A simple rule to follow is this: if an item hasn't moved in 60 to 90 days, it is eating your cash and not growing your business. Let me give you a festive example that highlights this problem. A retailer with an annual turnover of 54 crores purchased 10 crores worth of stock before Diwali, expecting bumper sales. But during the festival, the actual sales amounted to only 7 crores at cost. That left 3 crores worth of stock unsold. While the shelves were full, creditors were demanding payment within 60 days. This unsold 3 crores worth of stock had locked up the working capital. The retailer had profits on paper but no liquidity in hand. This is how festivals, which should ideally boost cash flows, often end up creating financial stress due to over purchasing. Now, time for another quick poll question. Let me ask you all honestly. How many of you have at least 20% of your stock that is older than 6 months? I request the audience to submit their responses. So yeah, I have seen majority has answered yes. So if your answer is yes, then you already know where your cash crunch is hiding. That stock is money lying idle. And if you're not sure, it probably means your stock analysis systems are not giving you the right visibility. Either way, the answer to this question tells you exactly how disciplined your inventory management really is. The second big problem is dead stock and changing fashion cycles. In retail business, fashion changes rapidly. If you don't clear stock on time, it becomes outdated and unsellable. The root causes are buying trends without proper liquidation plan, not running clearance campaigns when required, and stocking too much variety instead of focusing on proven designs. The solutions are equally practical. Create a systematic clearance cycle every quarter. Use seasonal discounting smartly as a promotional tool, like bundling them with high margin products or bundling with new product launches. And focus on depth rather than variety. In other words, stock more of what sells fast and less of what just looks good on your shelves. Dead stock must be treated like a disease. The longer you keep it, the worse it becomes. Time for a quick poll question. Now, think about your own shop. What percentage of your stock is more than 1 year old? I see around 33% of the people have answered more than 20%. If it is more than 20, you are sitting on a cash time bomb. That old stock is not wealth. It is cash that has been locked away for months or maybe even years. And the longer it stays, the harder it becomes to sell. So, this is a reality check question for every retailer here. Now, let's quickly summarize this session on inventory. Stock is not wealth, stock is blocked cash. Excess inventory is the number one reason why even cash rich retailers struggle to pay creditors. High sales volume cannot compensate for poor inventory management. The way forward is regular aging analysis, performing STR analysis, strict purchase discipline, and quarterly clearance cycles. These are not optional practices. They must become part of your business routine. And most importantly, you must move away from emotional stock buying and shift to data driven purchasing. Numbers must guide your buying decisions, not feelings or festival excitement. Before we end this section, here's one action you can take immediately. Tonight, go back and split your stock into three categories: moving stock, which is 0 to 90 days old, slow moving stock, which is 90 to 180 days old, and dead stock, that is, which is lying for more than 180 days old. Once you do this, calculate how much of your working capital is stuck in dead stock. That number will explain your cash crunch far better than your profit and loss statement. If you can also take this one step seriously, you will already be ahead of 90% of the retailers who never measure their stock this way. Thank you for your time. Now I am handing over the session to my colleague Kumar.
Thank you, Sudharshan, for the wonderful introduction and for valuable insights. Uh, in this session, we'll see an important topic, margin leakage and the pricing gaps. In retail, every owner might proudly show large sales numbers, the crores in turnovers. But the real question is, how much margin are you actually keeping? Many times the leakage isn't the sale in volume, but in the margin gaps that go unnoticed. Even a small 2 to 3% leakage on your 50 crores of sales means 1 to 1.5 crores wiped out. That's real. Money disappearing silently. The margins don't vanish in a big explosion. They leak in a teeny hidden ways. Today we will look out where the leak happens and how to spot them. And most importantly, how to plug them. So your profit stays in your pocket, not lost in the system. Let's talk about the first leak. The blind discounting and why does it happen? First, there is no SKU level margin tracking. Many of us panic to increase the sales volume or just want to match the competitor discounts. Sometimes it's simply because we don't have a clearance strategy for old stack. So let's see some solutions related to the margin leakage. Start with the SKU wise margin analysis. Not all products give the same profit. Some give more, some less. If you give the same discount on everything, you lose money on your best items. Better way is check your product mix. Give discount only on the slow or old stock and protect the good profit items. These ways sales go up, but profit stays slow. It means you're already losing your profit. Okay, then keep it as a low. So by following the product mix. Then we'll see the next run selective discounting. Focus only on the slow moving or old stock. Don't discount fast movers or your core products. And then train your staff. It's an important one. You should train your staff and teach them to the cross sell high margin products along with your discounted items. That the way every bill carries profit. And importantly, don't incentivize the employees heavily for the selling the discounted items. Otherwise, they will push more of what kills your margin. Let me share a simple example. Generally, the shops will put a blanket 10% discount on everything. So even the new arrivals get discounted unnecessarily. What happens? The profit erode without clearing the right stock. Now compare that with a disciplined approach. Implement the implement the SKU level margin discipline. Restrict the discounts to only the slow moving or selected fresh stock that needs support. What's the result? The old stock clears. The margin on the new arrivals remain protected and you're still competitive in the market. This is the power of the selective discounting. It helps to clear your stock and save profit and train your customer to respect the value instead of the always expecting it as a flat discount. Let me ask you one question. How do you decide the discounts in your store today? Is it gut feeling, competitor pressure, clear stock strategy, or SKU margin data? Good. Most of the participants are voted to the clear stock energy. So, sorry, the clear stock on old stock. But the most retailers still operate by instinct or pressure. But in real business, discipline means letting the numbers decide. Because the margin doesn't lie, it tells you the exactly where to act. Now let's see the another silent killer is the wrong pricing strategy. And why does it happen? Many times the retailers just follow up the supplier's MRP sessions without any question. There is no differentiation between the premium and volume products. And there is a fear of losing customers and if prices are a little higher. But think about it. The premium silk carries can comfortably hold a 60% margin. And in everyday cotton sarees may only carry 30% of their margin. If you treat the both the same, you are undercutting your own strength. The only solution is to adopt the value-based pricing. Differentiate by category and your design trends and the demand. And very importantly, review your pricing every season, not just once a year. The trends and demands changes, and so must your prices. So let's summarize the session 3. Number 1, the blank discounts are the silent killers of margin. They reduce profit without necessarily clearing the right stock. And number 2, the wrong pricing models undercut your business strength. When employees are Number 3, when employees expect higher incentives only on the discounted products, they might actually allow stock to age deliberately so that later they can push it with a discounts and earn more incentives. That's a dangerous culture. And then the solution lies in the margin-based decision making, SKU analysis, selective discounting, the value-based pricing, and staff training. If you discipline yourself here, you protect crores of profit year after year. And then let's see a small key takeaway on this session. Always remember this. Sales never exit, margin sustains. The profit is not made when you sell. The profit is made when you price. If you fix your pricing and discounting, you automatically fix your profit. Here's your action step. Before the next festive season, sit with your sales report. Identify your top 50 SKUs by sales and write down their gross margin, then decide which deserve premium pricing and which should go on clearance. Do this one exercise with a discipline, and I promise you, it can protect your crores of margin in a single year. It's just a simple, practical, and a powerful. Now let's move to the another profit illusion, the overhead creep and the cost indiscipline. The sales may be growing, but profits vanish because of something subtle rising overheads. In retailer, the rent, the salaries, and the utilities rise slowly over the period of time. So we don't notice until they have eaten your 5 to 10% of your margin. Today we will expose where these hidden costs lie, why the retailers lose discipline, and how to take back control before the creators start chasing your payments. Now let's see the first and foremost problem in your daily business, rental and utility escalation. Normally, the prime location shops pay heavy rent and power bills, but many owners don't track their rent plus electricity as a percentage of the sales. And, and the lease agreements have an escalation clause. Utilities like ACs and lighting run endlessly, and no one checks the ratio. Here, the solution is to fix a clear benchmark. The rent plus utilities must be the less than or equal to 8% of your sales. And shift your energy efficient lighting and ACs and use your scheduled usage to save. And if rent exceeds your threshold, renegotiate or sublease your unused space. Without your control, your shop will keep growing the sales, but your landlord and electricity board will take away your profits. Next, let me ask you all of you, do you know your rent plus electricity percentage of sales right now? Let me answer this question. A majority of the people answered no or rough idea. That's already a warning sign. Because what you don't measure, you cannot control. So if anyone who is tracking this percentage, you are doing great and keep it in forward in future also. And the next problem, the staff cost misalignment. As a business grows, the staff cost balloon. Why? Because during the festive rush, we hire emotionally without measure real requirements. We rarely track productive benchmarks like sales per employee. Sales rise annually, but efficiency doesn't. The solution is discipline. Fix a benchmark of annual sales per employee according to your category. Review the staff headcount periodically. Analyze the sales per square feet. When productivity is tracked, staff costs remain under control without any hurting their service. Let's see an example. Suppose in your saree section, one salesperson should ideally generate 25 lakhs in a year. If you have if you have 4 sale people and sales are only 60 lakh, it means you are overstaffed. Another example, in a 1,000 square feet shop, you have any 5 salespeople cannot handle the customers comfortably. Adding 3 more will not increase your sales. It will only increase the salary cost. As business grows, many retailers hire more and more staff without checking the productivity. By fixing the benchmark for sales per employee, reviewing the staff headcount often and tracking sales per square feet, you ensure cost remain under control while service quality and remain strong. Let's see another poll. How many of you calculate sales per staff member annually? Yes or no? Majority of the people answer yes. If anyone answer no, if you don't, you are rewarding inefficiency without realizing it. Tracking this one ratio can transform your payroll into a profit driver instead of a cost burden. Let's see the another profit illusion. Sales promotion expenses. For example, once 62 crore retailers ran a free gift with purchase campaign. The customers buying above the 3,000 got a household gifts. The store spent 1.1 crore on the gifts, made a 2 crore in sales during the campaign, and only 60 lakhs in margin and ended up with a 41 lakh loss. Here's the root cause. Why? The focus on the top line, not bottom line. The management celebrated the higher sales but ignored the margin erosion. There was no ROI analysis. The customer behavior misread. The customer postponed the purchases just to get the freebies. The repetition fatigue made buyers expect gifts every year. The normal sales dipped before and after the campaign. If you measured promotions, if you are not measure the promotion, it eats your profits like a piranhas. So let's see the solutions of your promotion expenses. So in the way forward, first you plan promotions with the ROI in mind. Every campaign must either generate profitable margin or real brand value. The second, shift from the expensive gift to your loyalty points or bundled low-cost add-ons that encourage the repeat purchases. Third one, make campaigns time-bound, not too frequent. Let them feel exclusive. So if you conduct the campaigns in regular and too frequent, it they doesn't feel any excitement. So and finally, negotiate with your suppliers. Let them sponsor part of the cost in return for visibility. That the way promotion build profit instead of burning it. Let's see the impact of the promotional expenses. Promotion without control can cause a big cash lockup. The money you spend on gifts or freebies burns cash instead of your building profit. What happens next? You delay payments to your creditors by 15 days because your working capital is stuck in that promotion. Even worse, sales get disrupted. The staff report that customers stop buying on normal days and only wait for the freebies days. So instead of increasing your business, the promotion damages your cash flow, strains supplier relations, and disturbs your regular sales. To summarize this session 4, the overheads expand silently if not measured. The rent, payroll, and the promotions, all of them grow it left unchecked. The rule is simple. If the expense doesn't directly, if the expenses doesn't grow your sales and your or improve efficiency, it is like eating your profit. And the ratios and benchmark must be reviewed monthly to prevent the creep. Every 1% of you save in your overhead goes directly into your profits and build creator confidence. Small improvements add up to a massive impact. And let's see the action step. List your top 10 overheads. Write down the percentage of the sales today and versus 2 years ago. You will save, you will clearly see the creep. Now pick up two costs you will cap from next month. Even 1% correction on a 50 crore business equals to 50 lakhs cash back into your hands. That's the power of overhead discipline. Thank you. Next over to my colleague Padmesh.
Thank you, Kumar, for those lightning insights. Hi everyone. I'm Sharan and I'll be taking you through the important segment of retail illusion on profit, that is, profit diversion by owners. So, one of the most common problems in retail is tax and EMI commitments. Businesses often look at profit before tax but forget that taxes are real, immediate, and unavoidable. On top of that, EMI principal repayments don't appear in the P&L but quietly eat up your cash. So while the P&L looks healthy, cash disappears quickly. Owners take loans without mapping repayment to future cash flows. It's like planning a road trip to Ladakh without accounting for fuel cost. You'll run out of the fuel halfway through the trip. To fix this, prepare fund flow forecast, not just P&L. Calculate free cash by considering profit after tax by deducting tax, EMI principal, and fixed investments from profit before tax. Introduce a debt service coverage ratio. Check before borrowing and avoid over leverage for asset purchase and go with the phased investment plans. Remember, taxes are unavoidable, so you should always consider the profit after tax. See, the tax department doesn't accept, I'll pay you next month. They are like your strict landlord, always on time at your door. Here we see a classic example of how profits on paper can mislead us. This business had 31 crore in annual sales and showed 3.37 crore profit before tax, roughly 11% of sales. But after paying taxes and handling 2.14 crore in loan repayments, they were left with just 11.79 lakhs of real free cash. And remember, this doesn't even include capital withdrawals or other commitments, which made liquidity even tighter. If they start preparing fund flow forecasts and plan their tax and EMI outflows properly, they can avoid supplier defaults and improve their cash flow. See, the profits on your paper are like Instagram likes. They make you feel good, but they don't actually pay your bills. So another common problem in retail is owner withdrawals. Many business owners treat their company just like an ATM, swiping out funds whenever needed. They withdraw heavy sums for monthly expenses, fixed commitments like EMIs, land purchases, or even parallel ventures. But this often leaves suppliers unpaid and creates a cycle of mistrust. Imagine running a marathon but stopping every mile to buy an ice cream. You won't finish the race. In businesses, undisciplined withdrawals stop business growth. Why does this happen? Usually, the owners don't pay themselves a structured salary. Instead, they believe if my business earns, I can take it out. Combine that with prior personal commitments, and the business starts suffering. Then everyone would be like, then what is the solution? Just pay yourself a fixed drawing like a salary instead of withdrawing lump sum amounts and maintain separate accounts for personal and business purposes and establish a reinvestment policy before you withdraw. Let's move on to another example. This business had 31 crore in annual sales with a profit after tax of 2.25 crores. However, there were other commitments worth 2.14 crore, mainly for loan repayments and chits. On top of this, the owner withdrew 1.28 crores for personal expenses like land purchases and insurance. As a result, the company faced a cash deficit of 1.16 crores. Because of this shortage, creditor payment days were delayed, stretching to 121 days, which damaged the supplier relationships. To fix this, they can introduce a withdrawal cap and a reinvestment law. They reduced creditor payment days from 121 to 90 days by clearing 2.07 crores of outstanding creditor balances. The key takeaway is that controlling owner withdrawals and prioritizing businesses' reinvestment can improve liquidity and strengthen supplier trust. Let me ask you a quick poll question. Do you calculate EMI principal and tax impact before spending profits? Okay, you got the answer right. Yes, always calculate a EMI principal and tax impact before spending your profits. And the third major issue is diversion of profits to non-business investments. Many owners lock money in chit funds, real estate, or gold while suppliers wait endlessly for the payment. Why? It's driven by a safety mindset. Owners think these are safer or they fear retail's volatility. But the truth is, the highest return on investment is usually reinvesting in your own business. The solution is treat a reinvestment as priority. Create a working capital budget annually before making non-business investments. It's like putting all your energy into decorating your neighbor's house while your own roof is leaking. Looks nice from outside, but you're the one getting drenched. Now let's move on to next case, that is credit sales illusion. Note, the retailer chosen for this example doesn't have a bank OD facility. A retailer with 57 crore sales booked 8 crore in school uniform sales. On paper, the P&L showed 1.2 crore profit. But here's the catch. 80% of the sales were on 90-day credit, while suppliers wanted payment in 30 days. Cash was blocked, creditors piled up, and profit was just an illusion. Here, the main issue is that credit terms with the customers are longer than supplier credit terms, and the concern is relying more on accounting profit instead of cash profit, followed by weak receivable follow-up process. Solution to this stress is align customer and supplier credit terms with back-to-back agreements. Use invoice discounting for large sales to free up cash, and track receivables weekly with clear accountability. If you don't have any bank OD facility, then introduce a bank OD facility to bridge the temporary working capital gaps. It's like lending your friend 10,000 for 3 months while your landlord demands rent tomorrow. On paper, you're rich, but practically you're broke. Profit on credit sales are like promises from politicians. They look big today, but take forever to actually arrive. So let me summarize this segment. Diversions of cash break supplier discipline. Delayed payments destroy goodwill and your future credit opportunities. You must make withdrawal policies driven and treat your owner withdrawals like a structured salary and not as an ad hoc ATM transaction. Reinvestment locks protect your business health by ensuring that the business needs are fulfilled first before the personal investments. And fund flow planning prevents surprises by accounting all outflows, not just the P&L expenses. Think of your business like your own body. If you keep draining blood randomly for other users, sooner or later the body collapses. Suppliers don't care about your profit numbers. They care about your payments. After all, you can't pay a vegetable vendor with the last year's balance sheet. Here's the key takeaway from this segment. Your creditors don't get paid from your profit. They get paid from your cash. Every rupee diverted is a rupee stolen from the business health. This punchline was adopted from the movie Godfather, released back in 1972. So this is not a paid promotion of the movie. So let's move on to next. This is a powerful reminder that cash, not accounting profit, is what drives survival. Profit feeds your ego, but cash feeds your supplier. And trust me, suppliers have much bigger appetites. So the metrics to keep tab on, key metrics to track and monitor for disciplined growth. I'm going to show you how the right set of metrics act as a control dashboard. These metrics will not only help you measure business performance, but also track, manage all the 5 areas we discussed earlier: profit illusion, inventory black hole, margin leakage, overhead creep, and owner withdrawals. This way, you will have a structured approach to ensure discipline and sustainable growth. Next, we move on to scorecard metrics. Think about any sport you follow, whether it's cricket, football, or basketball. Every game has a scorecard. The scorecard tells us who's winning, who's behind, and where the game is heading. Imagine watching a cricket match without knowing the runs or wickets. You will be completely lost, right? In the same way, every business also has its own scorecard. Instead of runs and goals, we track certain financial vitals, metrics that tells us whether our business is healthy, stable, or heading for trouble. Just like a coach checks the score to plan the next move, as a retailer, you need to track your business scorecard to make smarter decisions. Every retailer must track four key metrics: whether your inventory days is less than 90 days, net margin percent should be around 10 to 12%. Creditor days must be between 45 to 60 days. So owner withdrawals do not have a fixed percentage and vary from business to business. However, what remains constant is the need for discipline. Until working capital is managed properly, owner withdrawal should be carefully controlled to avoid putting additional stress on the cash flow. Once the working capital cycle is streamlined and stable, owners can withdraw whatever amount is required without affecting the business operations. Together, these metrics act like your business health report. Just like your doctor checks your BP, sugar, and cholesterol, you should check these financial vitals regularly. Ignore them, and you will be heading towards a heart attack. I mean, financially speaking, tools don't replace judgment, but they just sharpen them. This entire webinar is about mastering retail cash flow. Sales volume alone does not guarantee wealth. Even 50 crore sales won't help if cash isn't managed properly. But with just 20 crore, you can create a wealth if you manage cash flow well. It's like a water supply. Having a big tank doesn't help if the pipes are leaking. Managing the flow is more important than the size. Remember, turnover is vanity, profit is sanity, but cash is the reality. Now let's do a quick financial reality check. Running a retail business is not very different from running a household. Think about it. If groceries pile up at home, you don't keep buying more. If your monthly bills suddenly creep up, you find ways to cut them. And if there's a little extra cash left at the end of the month, the wise choice is to save or reinvest, not to drain it completely. In the same way, retail finance also needs discipline. The same common sense you use at the home, just with a few extra zeros attached. And that's where this 5 step roadmap comes in. It's simple, practical, and ensures your business remains financially healthy. All right, now let's do a financial reality check, retail financial reality check. There are two important truths every retailer must remember. First, cash sales is not equal to cash health. Just because you're selling doesn't mean you are generating healthy cash. And second, profit is not equal to payability. Showing a profit on paper doesn't always mean you can pay your bills on time. That's why we need a 5 step cash roadmap, simple practical steps to keep your business financially fit. Control stock, free cash. Run a weekly inventory aging check. Anything older than 120 days, liquidate it immediately. Tie new purchases to actual sell through. The impact: you release blocked cash from dead stock and free up money to keep the business moving. Protect margins at SKU level. Margins get eaten away by blind discounts. Instead, run SKU level margin based pricing. This alone can put an extra 3 to 4% cash back into your pocket on the same sales volume. Fix overheads before they creep. Don't wait for costs to balloon. Do quarterly expenses audit. Optimize staff by rotating idle resources or digitalizing routine tasks. This small discipline saves 2 to 3% of your annual cost, money that would otherwise silently drain out. Reinvest, don't drain. Whenever you generate surplus, don't just pull it out of the business. Build reinvestment reserves for stock, creditors, and growth. This builds supplier trust, improves your credit standing, and strengthens your reputation in the market. Ensure fund flow transparency. Do a monthly cash flow forecast. Maintain a clear fund allocation statement after every closing. The impact is powerful. Zero surprises. You will always know exactly what's payable and when. So, in short, control, protect, fix, reinvest, and ensure transparency. Running a retail business is not very different from running a household. Think about it. It's just similar. So let me leave you with one thought. Business success isn't about chasing sales alone. It's about keeping your financial engine healthy. Just like a car can't run on an empty fuel tank, a business can't grow on weak cash flow. If you track the right scorecard, follow financial discipline, and make small corrections consistently, you won't just survive, you'll thrive. Remember, profit is just a number, but cash flow is your reality. Manage it well, and the future of your business is always in your hands. So, before I wrap up, I would like to thank you all for your attention and patience. Especially, I know that I'm the only one standing between you and either a coffee or a nap. We hope today's session gave you useful insights to take forward. With that, our team officially concludes this webinar. Thank you once again. May your Wi Fi always be strong and meetings always short. You can post your feedbacks.
It's really nice. Keep going, and it's very useful for us. Thank you so much.